All right, good Thursday afternoon. Investors, traders, Phenom Group members, how we doing? I know the price action has not been exactly appreciated by the bulls of late, but we've gone from, let's call it overbought territory to oversold territory. Folks, in the oversold tank is getting filled up quickly. We'll look at some oversold conditions indeed. As I've been saying all year long, this is going to be a very choppy and turbulent year when you have the Fed involved to the extent it is. There's a lot of misnomers out there, right? The recession that we've been supposed to be fighting, all the year. Don't fight the Fed. The Fed put is gone. There's a lot of nonsense out there that, it means nothing. There's no practical usage of these colloquialisms and stuff. I was listening to CNBC. You don't mind if I share with you, do you? All right. So I was listening to CNBC yesterday, and Josh Brown was on, and he literally said the Fed put is gone. And I want to reach across the screen and just, it's like counseling. You go to counseling with your significant other maybe, and the counselor says, well, how do you feel about when she, and you just do one of these, just. And so when he said that there was no Fed put, I'm like, there's always a Fed put. It's just been put away for the time being. Okay, it's in the closet right now. I'd be of the opinion it's going to come out of the closet in Q1. Probably not the best phrasing, admittedly, but you know what I'm saying here, okay? I got my back. I'm just in bad boy mood, I guess it is. I have to do my hair. Broncos football season. Come on, we got Russell Wilson, but let's get focused on the markets. All right, I'm a little sidetracked here. Overbought conditions. Now we have oversold conditions. Let's not forget where we came from, as always. And as we do religiously here, we like to start with some, very sage words or phrases and what have you. I had read an interview, and you won't find this, by the way. This is mine. I actually archived it. One day I'll probably auction it off. It's unique. It's my own NFT, if you will. But in 1987, shortly after Black Monday, Peter Lynch was interviewed about the minimal hedging incorporated within the Magellan Fund. Right? You're familiar with Peter Lynch, one of the greatest fund managers of all time. From 1977 to 1990, he managed the Magellan Fund of Fidelity. So the question he was asked shortly after Black Monday, right, the big 20% drop in the market, he was asked about the minimal hedging incorporated within the Magellan Fund. This was his response: perpetually planning for downside in constructs that perpetually move higher is a puzzle to me also. So it's kind of like he answered the question, but didn't answer it directly. It's a very passive way of answering. He's like, I know. Why do people hedge? If something's going to go up over time, just wait a little longer and buy at a discount. Peter Lynch is also famous for just very frankness of speech and, kind of a jovial way. He admits he's been in 10 bear markets, and every single one of them, he beat the market to the downside, meaning that he was down more than the market every time. He was a perfect 10 for 10. Okay, let's get into some data here. Remember, we had a breath thrust, right? We went from less than 15% of S&P 500 stocks trading above their 50-day moving average to greater than 90% of stocks trading above their 50-day moving average. Okay, but then we've had this big correction. It is a big correction, right? We had a 50% retracement off of the June lows during the 2-month rally. But guess what? We've just retraced 61.8% of that rally. So what happens historically when you've gotten, this kind of a breath thrust to 90% of stocks above their 50-day moving average, and then you close at a 20-day low in the S&P? All of a sudden, you're at a 20-day low. Does that mean that the rally was fake, that there's nothing good, it was just a bear market rally? Historically, not really. Close at a 20-day low, 5-day change going forward, we always go to the win percent or the positive probability. Why? Because we don't know if we're going to get the average return, the median return, or a decline. So we look at the win percentage. The win percentage is 75% of the time the 5-day change is positive. 10 days later, 67% win rate. But check it out. When you go 21 days, 42, 63, 126, and 83%, 100, 100, 100, 100, going out 12 months. So it doesn't feel good. It feels like, and you're hearing it all over the place, that was just a bear market rally. Where's Mike Wilson from Morgan Stanley? Let's bring him in. Where's Savita Subra? Of course, I can't say her last name when I'm doing a video. Subramanian of Bank of America. Let's bring her on air, right? CNBC's bringing out all the bears now that we retraced pretty significantly. But history tells us, kind of to be expected, maybe it is a little bit more than people were anticipating, and it's come, in a rather rapid fashion, but we've been here before. It's happened. And history says this is a dip you should buy, unless the macro fundamentals have changed. And we'll talk a little bit about those macro fundamentals. All right, so we had this, you could argue, overbought condition. Since then, we've gone from overbought to oversold. And within that process, we've seen the 10-year yield, right? Now, during the rally, we saw yields go lower. We even saw some consolidation in the dollar. But now we've got the dollar at yet another multi-decade high here today. And the 10-year yield has gone above 3.25% today. What has happened in the past? We talked about it. When the TNX, that's the ticker symbol for the 10-year, goes above 3%, 5 days later, market's been down. It's taken us 19 days to recover this year. It's happened 6 times. It's taken us a full 19 days to recover from some of those losses. The dollar, we looked at this chart last week. It looked like, we had a bearish relative strength divergence as we were double topping here, but we still went higher. We still went higher. Multi-decades high today as we speak. These are not good for risk assets. Rising yields, rising dollar. They put pressure on the bottom line of large cap growth multinational companies. But we are getting oversold. And again, we came from overbought conditions, the 10-day advanced decline line, into overbought territory. Here's oversold. You want to be buying down here. That's why it's in this color. You want to be a seller up here. Well, you want to at least hold, in my opinion, if you're a long-term investor. Just hold on and look for the next opportunity to add, to your portfolio. And forward looking, when you have the 10-day advanced decline line rising to that extreme, a week later, 50-50 toss up. A month later, 62%, which seems, the majority of the time the market's higher. But we like 70 percentiles and we love 80 percentiles. Heck, of course, we love 100 percentiles. But we got overbought. That's the point. And now we're getting oversold. So we looked at this, when we were overbought. Those were the returns, the 20-day low. And now, same thing, 20-day low, not too shabby. We also looked at it this way, just going back to 1988. You see in this table, we're at 1963. So there were bigger returns. And you might ask yourself, well, Seth, there's no 7% up here. Why is there? These are closing basis readings. This, you're getting some intraday stuff. So you're getting, from start through the finish, you're getting some readings in there. Here's another one. Goes back to 1947. This didn't go back to 1947. This went to 1963, 1988. If we go all the way back to 1947, there was an 11% drawdown here. When you've gotten 90% of stocks above their 50-day moving average, doesn't mean you go straight up. There's been big drawdowns. Goes back to 1947. There was an 11%er, folks. This study came from Chris Shivako. So kind of want to go through some of the bullet points here. The prior studies did not go back to 1947 regarding a breadth thrust that carries 90% of S&P 500 stocks above their 50 DMA. This study above goes back to 1942. As we can see in the table, the largest one-year drawdown, 11.28% in 1947. So on a closing basis, the S&P 500 peak during the thrust period that we just came out of, the peak was 43.05 on a closing basis. The intraday high was 43.25. So from the closing basis, 43.05, we've dropped 8.4% as of yesterday's close, 39.55 on the S&P 500. We've dropped 8.4% from the 43.05 closing basis level during that breadth thrust period. Yes, it's more than the 7% here. It's more than the 7.62% here. It's less than the 11.28% here. We're still in the realm of a normal and to be expected drawdown. It doesn't feel that way. There is precedence. There is precedence for this. Now, if we are to get, the 11%, I don't want to get decimal points and everything. So let's say we do an 11% decline like we did in 1947 here, that would take us down to 3,800, a little more than 3,800. So it's possible. We talked about this in our weekend research report. These are possibilities that you have to consider. All right. Here we are. We're at the end of a quarter. We're at the end of a quarter right now. Remember these studies. We had a 15% down quarter for the month for the second quarter. It was down 15%. The first half of the year, or 2 quarters, we were down a little over 20%, 20.58%. When you look at the next quarter results, it's almost always higher. The only time it wasn't was in 2008. It's the only time when you've dropped 15% in a single quarter or 20+% in 2 quarters. The next quarter, you were up every time except for 2008. The next the next 2 quarters, you were up every single time. And over the next full year, again, up every single time. Where do we need to be to ensure that the next quarter's results, which is this third quarter, which ends at the end of this month, right? We're in September now. It's the last month of the third quarter. We have to be above 37.85. That's where we ended June 30th. So we need to be above that for this study to prove positive, for the next quarter out. And obviously we want, the 2 quarters, which is this column here. We want that to come to fruition as well. And we go over a lot of quant data, every week, whether it's in the weekly state of the market or in our weekend research report for Phenom Group members. And if you don't receive our weekend research report or our weekly state of the market in real time, Thursday and Sunday, subscribe today at phenomgroup.com. It's only $9.99 a month. Cancel anytime, although we doubt that's going to happen. All right, so with that, the Fed QT is about to double, right? Starts this month. It goes from 45 billion of balance sheet runoff to 95 billion. No more Fed put, says Josh Brown. The manufacturing recession, a housing recession, good economic data, so what? It equals bad news for the stock market. We retraced 50% of the 50% retracement. Did you think adhering to the quantitative probabilities would void negative headlines? Mr. Market is never easy, folks. It's never easy. Strap up your boots. We still have another 4 months left in the year. All right, so again, overbought to oversold conditions. I looked at every single, breadth indicator. I looked at all the indices. The McClellan oscillator is another internal market internal reading of market breadth. I looked at it for the NYSE, for the NASDAQ. I've looked at it for the S&P 500. This is the S&P 500's McClellan oscillator. And every time it gets down to these levels, these big low levels, draw your line, we go up. Draw your line, we go up. Draw your line down, we went up. Draw your line down, we had a nice bump here in February 22, but a rough month it was. We're bear market production. Again, here in June, big down reading, and we went up, and we're right back down here, folks. You can go look at any index, the McClellan oscillator for any index right now, and they all have very deeply oversold readings. Point being, and we can look at a number of different metrics. The stocks that are trading at 5-day lows, 10-day lows, they're all at their 2 standard deviation level. 75 to 85% of stocks are trading at both their 5-day low and 10-day lows. We usually get, reflexive bounces. I don't know how deep. I don't know how durable those bounces, the magnitude of those bounces, the duration of those bounces are going to be. Nobody does. But these are trading opportunities, and this is a year of managing cash wisely and mitigating drawdowns. How do you mitigate drawdowns? You look for oversold bounce opportunities. Buy these oversold conditions, and when we do get the bounce, you sell those rips. Mitigate your drawdowns on a year-to-date by looking for these kinds of oversold conditions. The NASDAQ 100 is under the lower Bollinger Band for 4 days in a row. This comes from me to us from Rennie Yang, and he says close below 12,285, and will be the 4th consecutive session under the lower Bollinger Band. Forward returns, we look up here. Up is win, down is loss. 10 times up 1 day later. Very mixed here, 2 days later. You want double digits because it happened 16 times going back to 1994. 1994 to 2022, 16 occurrences, 11 times. 11. 1 week later, more often than not, up 2 weeks. And here we're starting to get 12s, 11s, and 14s the further out in time we go. This is 1 month later, 12 times or higher, only 4 times down. 2 months, 3 months, 6 months. Those are your win probabilities there. And you can see double-digit returns and a lot of these going further out. So again, just another oversold condition. We looked at the S&P 500 10-day advanced decline line, and we used to be up here, right? This is the sell zone, or at least it's not the buy zone. And we dropped really quickly into oversold territory. This is the shaded color that is your buy zone. Again, just recognizing oversold conditions. Here's another one from Bank of America. The 12-month Z-score for margin debt hit oversold in June. Look at this. There's your line in the sand for the oversold condition. And that's where we were in June. And we're still pretty much down there. But, when you look at the forward returns, when the 12-month Z-score for margin debt is that, that washed out, if you will, 1 month return, average 4.2%, not too shabby, but percent of time up 77. 2 months later, 62. 3 months later, 75, 62. 12 months later, 87.5% of the time the market's positive. 18 months, 24 months, they're all 87.5% of the time, i.e. more often than not, the market is up the longer, you go out in time. This study goes out to 1998, goes back to 1998 from Bank of America. Margin debt, very low. Tells you people aren't buying this market. They're under leveraged. S&P 500 index seasonality, September sucks. You've heard that before, but it's kind of a toss-up, really. The win percentage, this chart right here, or study from Equity Clock, takes us back 20 years. The percent return, January, all the different months here, and here's September. It has a negative return, but 55% of the time it's actually positive, which, again, it's a coin flip. For all that you hear about September being the worst month of the year, the last 20 years, it's a toss-up. It's positive 55% of the time. But when the positivity rate is higher the majority of time, yet the average return is negative for the month of September, it speaks to the magnitude of the returns favoring bigger declines. You've had to have had bigger declines if you're up more often than not, and the average is still negative. Volatility, keep in mind, tends to tilt higher from September into October and through much of October. Here's another chart looking pretty much at the same, the month of September highlighted here from Carson Wealth. And this goes back to 1950. Everything's negative. Everything's negative. Now, here's one way of also looking at it. It's not that great. When the S&P 500 is down greater than 15% year to date heading into September, which we are, in 1962, that was the case. September was down 5%. In 1966, this criterion was met. The market was flat. In 1972, we were down 12% in the month of September. In 2002, down 11%. Now, down 15% year to date going into September. 1, 2, 3, 4. This is the 5th time. So take the data with a grain of salt. And it's very mixed, obviously. Down 5%, 12, 11, and flat. So grains of salt. Now, this does, according to Larry Williams, look very much, when he does analogs or juxtaposes different calendar year patterns for the Dow or the S&P 500, what he found was 1962 had the greatest correlation coefficient of any year, meaning the path is almost identical. It has an 85% correlation. I have it in my notes here, I'm pretty sure. Thought I did. Or maybe it's another one. Because I have the same data. Yeah, the same data from Sentiment Trader. 50-day S&P 500 rallies from a one-year low within correlation of greater than 0.85%. The year was 1962. So, and you've heard before, well, people are expecting a liftoff like 1982, right? Tom Lee of Fundstrat is expecting or forecasting, a 1982 liftoff. The same thing happened in 1962. As of right now, the 1962 analog has a greater correlation coefficient than even 1982. And yes, both years had a bit of a pullback here in the September month. We'll see if that analog actually does, prove itself out, because up and away for the Dow. You get this dip here, which we are getting now, this secondary dip, but then up and away. Secondary dip, up and away for the S&P. All right, I said we dig into a little bit of macro fundamentals, especially when it comes to, right, Fed. We've gotten so much good data here this week, but the market has it's the same thing with the jobs data a month ago, right? We grew jobs by 528,000 in the month of July. The market sold off for the next 3 days, only by 1%, but it's still sold off. Today, we got jobless claims down for 3 weeks in a row. And we're at a 9-week low in jobless claims. But the good news is being sold because, the Fed wants the economy to grow below trend. They said as much. Jerome Powell's speech at Jackson Hole said as much. So good economic news, is not facilitating the Fed's desired outcomes. That can change. Nothing the Fed said is set in stone. They're not even giving guidance. Everything right now is flexible, and that's the way the Fed wants it. They want to be able to adjust it to the real-time data if need be. If they need to hike rates a little faster, a little more, they want to be able to do that. If the data shows that they don't have to hike as much, then inflation is indeed abating faster than anticipated. They want to be able to pull back on those rate hikes, or at least the magnitude of the rate hikes. So the macro fundamentals we've been looking at, because the biggest input right now and the biggest headwind for consumer price index is rental property cost, right? That's been up all year long. Last year, it was up 17.6% year over year. Today, this year, we're half that pace, less than half that pace, at 7.2% year to date. This is the apartment list rental index, right? It's a national rental index. The Fed knows about this. They get this data too. But from a month-over-month standpoint, because these are all year over year, from a month-over-month standpoint, of the apartment rent index, and you can click on the link to go directly to the website, rose by just 0.5% in August, which was half the rate of growth compared to July, right? Remember, rate of change. It's not whether it's going up or down. CPI measures the rate of change. So you actually had a negative rate of change there. Unfortunately, there's a big lag when it comes to the owner's equivalent rent, which is the actual component in the consumer price index. This may not show up in the month of August when we get, the CPI reading in 2 weeks. This may not even show up until November, December. We'll see. There's a big lag when it comes to owner's equivalent rent. All right, this is a list from Fundstrat, speaking of Tom Lee. This is their data. Deflation. The top 50 components with deflation, as you can see here, starts food at employee sites and schools, down 33%. Telephone hardware, calculators, down 17%. You go all the way down the list. I highlighted the ones that are, their component, their weighting within the CPI, the consumer price index, is greater than 1%. So I circled them. Gasoline down 5%. 4% weighting is used cars and trucks. That's down another 1.5% month over month. Wireless telephone services down 1.2%. That's a 1.48% weighting in the CPI. But that is a long list, folks, of items that are coming down in price month over month. Fundstrat's Tom Lee, 42% of CPI components are deflating off the peak, equals inflation could fall faster than the consensus expects. All right, so inflation, we talked about rents. What else? Let's talk about manufacturing, right? Now, this comes from, for our members, you've seen this in the weekend research report, and you recall back in July, we started to give our forecast or our outlook for the manufacturing sector. And what we had said is that we were of the opinion that we were either at the trough or experiencing the bottoming within the ISM Purchasing Manufacturers Index and the S&P Global Purchasing Manufacturing Index. We expected the Q3 period to be the trough in PMIs, Purchasing Manufacturers Indices. And so last weekend in our research report, we wanted to update that, since we got the flash PMI from S&P Global last week. Today, we got the final PMI from S&P Global, as well as the ISM PMI data. So in our report last weekend, we said Phenom Group has previously outlined the opinion that we anticipate most PMIs troughing in the Q3 period before re-accelerating to more normalized levels in Q4 2022, blah, 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 blah. Read it on your time. Don't want to waste your time. Now, it's one thing for us to have had that outlook since late July. It's a whole other thing when you get a big institution like JP Morgan, their lead economist, if you will, basically saying the same thing as of this Monday. On Monday, Mislav issued his notes, And they basically believe that we're seeing a trough here in PMIs, and they're looking for an acceleration in the back half of the year, in the Q4 period. Let me see if I can find the exact verbiage. The potential back test from the current levels has produced strong market returns. That's important. I don't see it exactly, but I'm skimming, so read it. It's good stuff. But like I said, today we got both S&P Global as well as ISM, and today both ISM and S&P Global PMIs came in better than forecast, and we had a really nice bump in the new orders, right? Because that's what everybody looks at. What are the new orders? Are they growing? Because you can get a little bit of a bump in the ISM, Purchasing Manufacturers Index, but if you don't get a new order bump, people are going to poo-poo it. We got a big bump in new orders, folks. Let me see here. I can find, because I got the chart. No, I got the chart. There we go. Yep, there it is, folks. There's that bump. So we were wrong. It's happening right now as we speak, a lot sooner than, I thought maybe here in September we get the final week reading. Actually, I thought we get the final week reading, but it looks like we've already started to accelerate. And you would think, right, this data was issued before the opening bell. As soon as the data came out, the future started, well, we were in the first half hour trading. And as soon as the data did come out, 10 o'clock for the ISM, markets kept making lower lows. Right? Because again, the Fed doesn't want a strong economy. They want a below trend growth economy. The Atlanta Fed now, GDP now, was tracking 1.6% Q3 GDP, but after today's data, it jumped up to 2.6%. We were never in a recession, folks. It was nonsense. We didn't even get to recession territory with the PMIs. There was fear that we would because the new orders were so weak. And, oh, by the way, the prices paid component in the ISM, the prices paid, big move to the downside, second month in a row. Inflation. All these prices are going down, folks. They're going down faster than most people have anticipated. Red Book Johnson retail sales, we go over this on a weekly basis. Again, I'm still surprised at the strength of the consumer. Ever since paying down that credit card from the back to school shopping season, up, and away. We talked about, last week and in our weekend research report, I had tweeted this out on July 28th after the FOMC meeting. I don't think markets advancing, improving wealth effect is the desired outcome of the Fed. We may anticipate some pushback from Fed speakers come next week, potentially stifling markets advance since late June. V-shaped advance, it's not my outlook. It's going to be choppy. It's going to weed a lot of investors out. It's going to scare a lot of investors. We go up, we go down faster, right? Elevator down, but we take the stairs up. That's just how markets work, right? It's an emotional trigger. When stocks are going down, when prices are going down, people panic, hit the sell button. When things go up, it's a process. People have to think about it. How many shares? Do I really want to buy this? Let me go look at the tech. It's a big process. But when people are fearful and they're panicking, sell. It's really quick. It's an emotional, decision. But this right here, I believe the Fed would not want, in my opinion, the Fed wants every tool it can bring to battle when it comes to fighting inflation. Well, if the market just keeps advancing, people are going to feel better. They're going to see it in their 401ks. And then, you know what? Maybe I'll buy that other shirt. It's not going to help inflation. That's not going to help the Fed's mandate. So what did you hear at Jackson Hole, right? All the hawkishness you want, folks, right? We're going to keep the Fed's fund rate higher for longer, abnormally large rate hikes, right? And this may all sound speculative. speculative, right? I don't think the market's advancing is what the Fed wants. Until here's the response from Fed President of the Minneapolis Federal Reserve Bank, Neil Kashkari, says the quiet part, but he said it out loud. He literally says, I was actually happy to see how Chairman Powell Jackson Hole's speech was received. I put the link here because it was archived by Bloomberg's YouTube channel. And they ask him, and he literally says it. He says, I'm happy that the markets went down. I mean,
technology has just changed the game.
Pretty awesome, folks.
And it's really helped give us more of an edge.
I certainly was not excited to see the stock market rallying after our last Federal Open Market Committee meeting, because I know how committed we all are to getting inflation down. And I somehow think the markets were misunderstanding that. And I was actually happy to see how Chair Powell's Jackson Hole speech was received. You know, people now understand the seriousness of our commitment to getting inflation back down to 2%. To me, the most costly mistake we will make is if we get.
There you have it, folks. I've been doing this for 22 years. Kind of know how these people feel, you know. It does pay to be a Fed watcher. But here's the main takeaway. Have reasonable expectations. Have reasonable expectations. We held the opinion that we felt the market was going to actually reaccelerate in the back half of the year. We may be experiencing that, you know, the bamboo shoots, the green shoots, if you will, of that reacceleration. We'll need more data. Tomorrow is the non-farm payroll report, and you know, if it's too strong, the biggest component that people want to see is going to be, it's not just the headline number, which is how many jobs are created. It's the wage inflation. If that's still running hot, it's going to be a problem for the market that day, in my opinion. If it's not, I'll be very surprised. If it's not, it's going to be because the market is just way oversold. You know, if we get any lift, it's going to be because we're just way oversold. So I hope everybody enjoyed this weekend's state of the market. Again, you know, these drawdowns are to be expected. Does this exonerate, you know, the 50% retracement rule, the breadth thrust that we've had, things of that nature? You can't say 100% that it doesn't. But historically, these kind of drawdowns are to be expected. They're normal based on the data that we have at hand. Technicals, quantitative data, they can all be overpowered by the fundamentals. The fundamentals guide price ultimately. It's not the technicals, no matter what technician tells you that, you know, the technicals reflect the fundamentals. They can, they absolutely can. But the fundamentals, it's why we have gaps in charts, right? Earnings come out and all of a sudden a big gap up or a big gap down. But you told me that it was already reflected in the technicals. Now, fundamentals rule all. And just like they can produce those gaps in charts, they can overwhelm the quantitative data and all these studies that we talk about. So you have to be open-minded. That's the bottom line. Be open-minded. Manage your cash wisely. Look for oversold opportunities, you know, throughout the year to take advantage of. If you're down on the year, these are good ways to mitigate that drawdown, as well as improve your cost average on individual stocks that you want to hold long-term. With that being said, I'm Seth Golden. Thank you for joining me here, as always, on our weekly State of the Market. Trade safely, everybody.